Oh, good afternoon, everybody. Welcome back to Hurdle Rate. We're going to have some fun today. We're going to do a discounted cash flow analysis of Manchester United, a club that we all know and I guess some of us love. It's obviously one of the biggest clubs in the world. It's valued at billions of dollars. When Sir Jim Ratcliffe bought his stake, it was at about, I think, a $6.5 billion valuation. Its current market cap is, according to, yeah, on the that is of the listed company, is just over $3 billion. So what we want to do is we want to see. We know obviously he's got a global fan base, a very expensively assembled squad, but we want to find out what the club is actually worth from a financial perspective. And we're going to have to do this a bit differently from how we would normally do. And you'll see as we go through the way accounting seems to differ for football clubs. And yeah, we're going to build out the DCF. We're going to build out the WACC, the weighted average cost of capital, and we'll find out what the intrinsic value of Manchester United is. Yeah, so without further ado, let's get cracking. The share price over the last 5 years has been a bit. It's been better than the on-pitch performance, but you wouldn't be happy with this sort of return, I guess, if you're buying in at about just over, well, nearly $14, and it's $18 now over 5 years. If you put your money elsewhere, you'd have got a far better return. So yeah, first things first, go onto the SEC, pull up it's called a 20F on here, and just go for the most recent one. And this is the annual report because Manchester United, I'm pretty sure this is probably for all football clubs, is their end of the end of year is the end of the season. So this is these are the financials up to June the 30th, 2025. So go down to page on here. So F22 is quite far. You've got to scroll down on it, but this gives us a breakdown of the of their revenue, which is what we're going to do for the revenue build, and then obviously we'll build out the rest of what we need. So open your spreadsheet. First things first, as always, page layout, remove grid lines, go view, freeze the first column, make the insert another one, make A bit smaller, make B a lot larger. I think I can zoom in as well for you. And in A, type in Manu. That's the ticker. MANU. Go data, go stocks. Let's go ticker. Can I zoom it? No, I think I have to leave it at that. Go date. We want the current price, the implied. And then we want to see if there's any up or downside. And I'm hoping this will be quite fun because, I mean, I know what we would all do if we had a ton of money. We would go and buy a football team. So let's sort of fantasize and see what the financials are of a football team and how we would do it. Go home, just center your X. This is going to be the assumptions, and it's nice that they break down the revenue. They break down the revenue for us, so we can really get a full picture of what we know where the club's performing and where it's not. So yeah, assumptions. And let's use a red for Manchester United instead of the navy blue that we usually go for. So revenue segment. We want sponsorship. What's the next one? Retail. So retail, merchandising, apparel, and product licensing revenue. We'll leave that one. Just put it as retail. Domestic competitions. European competitions. Other than match day. Oh, I haven't filled the ticker in yet. Let me do that. So here we call these the switches. Where this is bear, the middle one is base, and then bull. Ticker, you go equal (17 of the 10th, 2025). No. Why did it do it down there? 17th of the 10th, 2025. And the current price is a 1 dot price, and we can leave those two for now. In switches, just put a 2, copy it all the way down. For this, we'll leave for... Normally we would put EBIT here, but we're going to be cash from operations, cash generated from operations, because that's how Manchester United report. And you'll see in a second. This is it's the EBIT added back with the depreciation and amortization, adjust for net working capital, and the intangible assets, the profit from intangible assets. I'll go through it once we get there. Oh. There we go. We just need 2 for this last bit, and that's our assumptions built out. Revenue build, and it's B10. So we go equals B10, bold it. Up here, we're going to say starting in 2023, and we'll go to 2030. Yeah, we have the full numbers for these. So yeah, 1, 2, 3, 4, 5. There we go. I can zoom in a bit more for you. That's better. Just format this so we say number. There we go. Sponsorship 189,496 and 177,770, 188,421. So it looks like the sponsorship is, to a certain extent, performance related, because obviously 23-24 they did not have a, well, they won the FA Cup, but they didn't have a good season, finishing, what was it, 8th? Then last year was terrible, but they still got to the Europa League final. So yeah, that probably elevated it, or certainly masked the bad performance that was happening in the league. I mean, still, it's, when you consider what's happened since Ferguson left, more than, was it 12 years ago now? I mean, this is still very impressive for such, say, mediocre performance to still be pulling in this level of sponsorship is incredible. And I think I think it will continue. So we will put 10% here as our base case growth by 2030. For the bear, because I think, I mean, these are lean years at the moment, but I do think it will improve. Yeah, I do think the foundation, I mean, the foundations will be rebuilt, and I think it will get back to, I don't think they're going to go back to dominating as they used to, but I think they will be competitive. So that should increase increase the sponsorship. Well, not just sort of, I think the sponsorship will be high, but it will increase it in terms of, I mean, if they're pulling in this sponsorship doing this badly, better performance will, yeah, that number will go up. But yeah, let's go down. Okay, so yeah, we take the previous number, we subtract, open brackets, previous number, subtract the final number, divided by the final year. Wait. Minus, no, okay, sorry. Close it again. So yeah, let's just go, sorry. Let's just format this to, no, we want percentage to decimal place. Equals the previous year minus the previous year minus the final year, close brackets. There we go. And what we want to do here, we want to lock in the column, but not the row. Lock in the column and the row. And then this one, just lock in the row. There we go. Oh, so this was... You know what, I think this will be, I don't think it's going to be less next year. I think they will have a better season. So let's not do an average of the last two. I think let's do it like this. That's better. And we'll put the bear case, the bear case can be quite bad, so we'll go 80%. But the upside, I think, is quite extreme too, so we'll go with 120. Lock the E10 in. Just pull it across. And we do the same down here. No. There we go. Put it across. There we have it. So for the percentage growth, forecasting the percentage growth, we want to simulate all of these different figures based on the switch we do. 1 is the bear case, 3 is the bull, and 2 is the base. So we always leave it on 2. And we go equals offset, open brackets, F27 for the cell that we're in. Then we take the switches, we take this for that one that we want to flick, for it to change, lock it in because we're going to pull it all the way across. There we have it. Looks good. Do the previous year multiplied by 1 plus the growth rate. Pull that along. There we... Oh, if you give me 1 second, let's have a look. So yeah, now we're going to do this for each of these different revenue segments. So we can just copy. Let's pull the whole thing actually. B11 retail. We just change the figures. 113390. 125106. 144853. And for this, it needs to equal G11. And this is really good growth. I mean, it could probably continue to do 20% a year because I mean, people keep even. I mean, let's say there's an uptick in form, more people will be wanting to buy. I mean, lots of people are buying the shirts now, but more people will be wanting to. And even though, I mean, there are now threats of, I guess, outside of the Premier League and the large European clubs. I mean, you see a lot of people wearing Messi into Miami shirts or Ronaldo Al Nassr ones. So that is, I mean, the Premier League will probably be quite angry that their dominance, their like, hoovering up all of the commercial opportunity is maybe not as robust as it was a decade ago, but it's still. I think the growth will still be. Yeah, I think it will still. I think it will still be huge, especially if the performance is even just slightly better than what it has been over the last couple of years. So domestic, then we do the same again. Oh no, sorry, we need to. C11. And this, let's go with 90 and 110. Maybe I'm being a bit too optimistic at 20. Let's go with 15. And I think, yeah, that's figures. I mean, look at that from 2023, 114 million. 2 years later, they're doing 145 million. It's phenomenal. Imagine if they'd had a successful period over the last decade, what that number would be. It's no other club would come. I don't think. Well, I don't think any. Yeah, I don't think any club would be able to match that. Domestic competitions. Okay, 174, 471, 161, 713, 136, 115. So this is this is finishing in the top three, winning the the League Cup, right down to. I know they got the Euro. Well, they went out of the cups early. I think in both of these in 2025, and then yeah, and then finishing 15th. Now the next. Oh, sorry. Remember again. Let's. I mean, it's going to be better than last season. Let's go 10%, and we'll put. Let's go. Yeah, let's say they do 10%. Again, it could be quite extreme, but I think there's probably at the moment probably more downside than upside. So when the risk is more downside than it is upside. So yeah, let's do that. So again, this one up here, you need to change this to C11. Pull it across. This needs to be C12. We pull it across. Here. Yeah, that's right. E12, I12, yeah. Look, yeah, that's fine. I'm happy with that. I mean, do we think maybe the Premier League doesn't actually the revenues? I think they've sort of started to plateau, haven't they? So, well, actually, yeah. I mean, I think yeah. That's okay. That's okay. We'll go with that. Now, European competitions. Now, this one is going to be a bit of a tricky one. European competitions, because for 2026 they didn't qualify, therefore they're going to have zero revenue coming in. So what is that? 28,504, 538 31084. This is crazy. Look, so 2024, they got in the Champions League. They didn't get out of the group stage, but they still got 54 million in comparison to the Europa League the previous year, where I think they quarterfinals to Sevilla. Then last year they get to the final of the Europa League and they get 31 million. So going out in the group stage of the Champions League is about 60% more than getting to the final of the Europa League. It's insane how much money's in the Champions League, and why I think clubs have to qualify for it. Otherwise, well, a lot of clubs, if they don't qualify for it, it can feel almost existential. So, okay, this is going to be 0. Sorry, 1 second. How do we do this now? Well, this will probably go up maybe, say, 10%. Let's put this as... G13. I mean, obviously this can't be, because they're not going to do it. So this year they are going to be 0, and then for the subsequent years we'll forecast that they do qualify for Europe, even if it's a Conference League. Even if it's a Conference League, then Europa League, and then back into, maybe in a couple of years, reconsolidate themselves in, re-establish themselves in the Champions League. What we'll do is, because this has to be 0, we just go minus 100%, send this to 0. We're going to go, okay, let's put, say 5% there, maybe go equals, and what, yeah, this has to be, let's go, because it is 0, then yeah, if we say, will it work if we do the switches? Yeah, the switches don't really matter here. So we can put, just block this out. So, yeah, I mean, these are the only ones that we're really focusing on. We're saying that they will qualify for Europe at the end of this season, meaning that next year we'd anticipate them to make about 28 million from, let's say they're in the Europa League and they get to the quarters or semi-finals. That's what we'd anticipate them to make. We can't really simulate that, but then going forward, we can. I mean, I don't think they're going to be. I mean, they're not going to be. I don't think they'll be competing for the Champions League if they make it in. But we can put more extreme upside on this if we want to, a more bullish. Let's go 120. Oh, I haven't done that. Yeah. So, but we'll keep it at 80% here. 13. I mean, this one doesn't really matter. Because if, let's say they qualify for Did that go up? If we put it onto 3, did it? No, because we haven't done this bit properly yet. Yeah, this not qualifying for Europe has really messed up our. But yeah, so 37 million. I mean, we could even go. Let's be a bit more bullish. Go 150. Because yeah, I mean that's not an unreasonable. I don't think if they do qualify, I don't think that's an unreasonable estimate. So yeah, okay, yeah, let's do it like that. Come back to normal. Then match day. This should be more straightforward because, and this goes I think for a lot of clubs in certainly in the Premier League, that their match day revenue is very loyal fan bases. So it doesn't really. Oh, no, we're not on match day. We're on other. I don't really know what other is, but it's not doing too bad. I think 6 million a year. We'll do it like this. Equals B13. Was it? No, B14. Other. Five, 7, 7, 8. Let's go average. What would we say other is? Let's go 3%. We'll put this as a 95, 105. G14, that was it. I'm going to change these up here. And it went down by 7% last year. Let's just say it goes up 1% this year. Okay, yeah, that's looking good for the broadcasting side. I mean, I guess this other probably comes from the in-house channel, maybe YouTube as well, and all of that sort of stuff. So yeah, let's go match day. As I was saying earlier, I think the match day is will be pretty robust because most, I mean, yeah, a lot of most of the Premier League clubs, even in the Football League, their fan bases are robust. They're loyal. They like to. They'll they'll go to the stadium through thick and thin. You say look at West Ham at the moment, not doing great, but their attendances are um, still huge. So 136, 420, 137, 130, 160, 263. So this is huge, this jump. It was consistent, around this 136, 137 mark for the 2 years previously. Then obviously when Sir Jim Ratcliffe came in and he's done a bit of, I guess, restructuring on the revenue side, and it's a huge jump, 17%. This, for now, the new stadium won't be ready until after 2030. So it will. Let's say this goes. I think it can go. I still think it can grow 10% because, again, if they start winning again, the demand will. It's already big, but it will surge even more. 15. I hope they qualify for Europe again though, because then it can make our spreadsheet look clean again. I don't like having this here. But yeah, I mean, once the new stadium comes in, they're saying it's going to cost about 2 billion, but it will go up to I think 100K. Uh, it could have 100,000 fans in there. Right now, that's about 75,000. So that would be nearly a 33% increase at this same price. This could, I mean, yeah. So if it's 160 now, what a 30%? Add an extra 50 million on that. Yeah, 210. Yeah, it will be substantial. So that's our revenue built out. Go border. Sorry, that should be the top one, not the bottom. Okay, so now we've built out this the revenue. Let's total it. We'll sum up the revenue, and we can then start moving on to the actual building out of the DCF. This was a harder revenue build than normal, just because it's very rare that you have a revenue segment that goes from making money to zero for 1 year, for one of the years that it goes. Yeah, it's pull this along. So I mean, by 2030, the club could be doing more than 1 billion in revenue. For it to get there, though, it does. Surely it needs to. On the pitch, it needs to improve. Yeah. I mean, is 2010? Do we think 10% is too aggressive here? Let's go 5, because without, I mean, they're not adding more seats into this stadium. It will be the next stadium that they actually. Oh, sorry. It's. And I think again, this is fairly robust. The bear case would be say 97% rather than the same with the bull case, because there's a fixed amount of seats. Yeah, okay, that looks good. So yeah, so we're forecasting about 1 billion, and in 5 years it will be about 1 billion in revenue. Okay, maybe I'm a bit too aggressive on retail as well. We'll put this to 10. Yeah, so just under 1 billion, I think. We can see now income statement. Yeah, income statement, revenue, and as always we just put it equal to this one, pull it across. You know what, we can actually, 1 second, let me just think about it in my head. We can cheat a bit and we'll go straight into the DCF. So as I said before, let's come up to where we need to be. It's a bit. No, it's not that one. Actually, it's operate. So yeah, it's actually doing a loss. There's a. Okay, this is what we need. This cash generated from operations. We'll go straight into into this. And we need to see what the taxes paid are. Yeah, we'll do that. I think it will work. So yeah, this is a bit different, and we're again ooh. So we're going to look at this, the cash from operations, the cash generated from operations. And what this is quite simply, so this line here, cash generated from operations, cash generated from operations equals your operating profit plus depreciation, and amortization. So let's call the D&A, plus any non-cash charges. And for that, what we mean are let me have a look. Profit on disposal of intangible assets. So when a player is sold, this profit is the sale price minus the book value of the player. So whatever the value of that player was on the balance sheet. So for 2025, this would have included the sale of, like, who did it have been? It would have been Scott McTominay, maybe that 5 million that came in for Sancho. Maybe was Alanga sold at this point? I can't remember. But they were pretty much zero on the balance sheet because they came through McTominay and Alanga came through the youth team. So I think, let's say one was 30 million, one was about 15, 16 million. So that was pure profit. But if it was somebody who was sold in that period, okay, so for Sancho hasn't been sold. It would have been. Has anybody been sold for good money recently from the club? I honestly can't. I mean, even Rashford, when he gets sold, let's say Barcelona pay the 40 million for him, that goes on as pure profit because he came through the academy. Okay, I'll have a think of one later, but yeah, non-cash charges is that profit on player sales, but we want to be looking at, we're adding that back in because we're going to take away the proceeds from sale of intangible assets, which is the total transfer fee that the club receives, irrespective of the profit. Non-cash charges, and then plus or minus any working capital changes. So this is all we have to do then is we've got our cash flow from operations. We subtract the taxes, we subtract the capex, and then the player capex, or the net player capex. Payments for intangible assets, this is money they've spent on transfers. Proceeds from the sale of intangible assets is transfer fees they've received from the sale of players. So yeah, that's how we're doing it from here. It's a bit more complicated rather than going EBIT minus taxes, add back in your D&A, subtract your capex, and then subtract your change in net working capital. But yeah, because of the way players are treated, player transfer fees are treated, that's why it's a bit more complicated. But yeah, okay. So cash generated from operations, 117,500. That's for 2024. I've got the other sheet up so that we can get the. I've got the previous year up so that we can get the 2023 figure. Where is it? I should have got this done earlier. Sorry, but it's good to see as it's being done live. These are sometimes the obstacles that you have to overcome when dealing with different companies, because each one uses different accounting methods, so you have to cater for that. So cash generated from operations, 128.9. 128.9. 900. And we want this as the percentage of revenue. Let's go straight into having our. I'll use one from up here because we haven't played with it. Let's say, let's say eventually this comes back up to 20%. Where are you? Here. And then if they have success again, I think it can go higher. I think the upside is significantly higher than the downside. F78. Sorry, okay, F78, comma, C17, I think, would it be? Yeah. Pull that across. One thing that the new owners will definitely be looking to do is to be increasing the CFO the cash from operations margin. Yeah, it looks good. If the company, Manchester United actually makes an operating loss, but because they've added back in the profit from the sale, it makes their CFO I guess positive, and their depreciation, but they don't actually list the actual depreciation on here. Do they do it on the income statement? Yeah, they do. Yeah. The depreciation and amortization. Because look at that. Each year, 196 million. Because obviously the players are every year of their contract that they use up, and if it's not getting extended, it decreases the value. So, for example, if you buy a player for, let's say you buy him for 50 million, you put him on a 5-year contract, he will depreciate by 10 million a year. And that will be his value on the balance sheet. Now, okay, we have our CFO. This includes our depreciation, and all of those other the working capital changes, etc. Let's do the taxes, and then we're going to start doing capex and player capex. They're treated slightly differently, I guess. So taxes, what did they spend in? So they actually made money on. I guess that's quite good if because the reason they weren't profitable is probably because of the player amortization, and that's obviously a non-cash expense. So, and then they end up getting a almost like a rebate. It's not bad. 6641, and we'll just go onto the other sheet to find out what 23 was. 3896. Let's go take an average of that. And I think because player amortization is so high, there's no reason that this will not continue having these tax credits. So remember, we have to, when we're calculating it, we have to add these back in, because this is, let's call it tax credit. We're going to add these back in instead of subtracting as we normally do, because this is not taxes paid, this is taxes credited. So yeah, let's not forget that. So the next thing we're going to look at is CapEx. Come back onto here. Okay, let's have a quick read of it. Yeah, so there are tax credits in respect to losses arising in the respective year. Okay, now we're looking at these two. So payments for property, plant, and equipment, that's normal CapEx. Payments for intangible assets, this is how much they've spent on transfers. So player recruitment. Wow, that's a lot. 278 in 2025, 190 million in 2024, and then they're receiving this amount here. But I guess, I mean, it's expected for, I mean, historically a club like Manchester United, they're not a feeder club. So when a player goes there, you expect him to stay there for the rest of his career. So what was I going to say? Yeah, you expect him. So you don't really expect there to be much on proceeds from sale of intangible assets. But in recent years, to balance the books because of things like PSR, the profit and sustainability rules, they've had to sell a lot of the academy graduates. So players like McTominay, Garnacho, Elanga, all of these players that came through the academy or have spent time in the academy, they've had to sell, and they're booking that as pure profit. Which, I mean, it's a bit frustrating because Manchester United, I know this is sort of going off topic a bit, but Manchester United have always been a team that have, built, their success has been built on their academy graduates, and they've had that wonderful statistic that I think they've had a graduate in the first team squad, for every match since something like maybe just after the war, which is phenomenal. And it would be a shame if they move away from that. Anyway, that little rant over. Let's go back onto this bit. $37 million, 48. Yeah, looks good. We want to know what this is as a percentage of revenue. The capex is actually very worrying for Manchester United on how this will look, because if they want to build this new stadium, that will cost, say, 2 billion. It will cost, let's say it takes 5 years to build. This will be something like 350 What am I doing? Sorry, no, I've done this wrong. I'll get back to what I was saying about the stadium in a second. Yeah, that's it. Okay, the reason this is so much higher is it was 17.5 million in 2024. Now it's 40, just under 45 million this year, is because they have redeveloped the training ground, I think. So yeah, that's why that expense is there. But otherwise, you would expect it to be in that 17-ish. Look here, 15.6 million. Okay, yeah. Then going forward, it hasn't been finalized yet. So let's just go for an average of these. Let's see what that would look like. Because I think, I mean, for the next 5 years, if the stadium gets the go ahead soon and is supposed to be ready by 2031, this will increase to, if it's a 2 billion stadium, this will be about 400 million a year, which, I mean, that's going to be, it's going to be a lot. So I think we have to start putting it towards, yeah, I think we have to say it goes to 15% of. Yeah, I think we'll have to go with that right now because we know that they want to build they will build the stadium and it will end up costing about two-ish billion. So if we factor in, yeah, nearly, well, maybe 750 million over in capex over this. Okay, so let's put it up to 25. Yeah, but I mean, with the stadium, it's going to obviously, however long you could say it lasts, let's say it lasts 60 something years. It'll be depreciated over that length of time. Now, player, so payments for intangible assets. Okay, let's just call it player recruitment, so we know what that is. $156. So this is going to really have to come down. They're going to have to be so much smarter on their recruitment because there's only been the only player that you would probably say is genuinely big money transfer that's genuinely been worth his fee is Bruno. The rest have come nowhere near fulfilling their potential. 27880. I mean, why? Like, this was mad. I mean, 2020 to 23, they were buying. Who did they buy? They would have bought Onana. 278 million last year. Who came in? Ugarte. I guess players like Hoyland would have been this year or this year. Yeah, so this would have been Onana, Hoyland. 24. Who came in? Yeah, I mean, so this would have been this would have been Euro, Delict, Dorgu, Mazraoui. Here would have been like Mason Mount, Onana, yeah, Ugarte in 2025. Yeah, so it's. I mean, they have to get smarter. This has to come down by by a lot because they guess it's not. They know they're not getting value for. Or yeah, they're not getting bang for their buck. I'm going to say that to be sustainable, they have to bring this down to 20% of revenue. And then proceeds, so then we'll go player sales. So 24, 25, they made 48. So yeah, this was like the McTominay. This would have been McTominay and Elanga, I think. I guess again, this in the recruitment this year would have been say Xerxes as well. So McTominay and Elanga, maybe that 5 million from the Sancho loan. what was it in? $31.6. And going forward, it's a difficult one because who's really worth big money? We know Rashford will probably go for about 40 odd million. But who else really has any resale value at the moment? I mean, all of the players that when we saw with Anthony, he goes coming in for, what was it, 80 odd million, and he leaves for, I know he's depreciated over 3 years on the from a normal balance sheet perspective, but he was nowhere near. I mean, of course, what I'm trying to say is that he went for nowhere near what the club paid for him. So it's the same with most of the squad. There's not really much resale value. Onana was bought for 60 something million, and now he's on loan somewhere to no big club wanted him. So yeah, you can't really, if you liquidated all the assets in one go, I don't think anybody would really want them. Okay, so let's calculate. Have I got everything? Yeah, let's calculate unlevered free cash flow. I think this will look terrible. So on this one, we take our cash from operations, we add back in the tax credit, subtract the capex, subtract player recruitment, and we add in player sales. Whoa. So yeah, this does not look pretty over the next few years, because if they are going to go and spend on the new stadium, it will. I think it will be an even larger expense than this. But yeah, they're really going to have to. But they're allowed to, because I guess they'll be bringing in. What is this? Nearly, let's say, 700 odd million of revenue, and that's increasing over the next few years. They're allowed to spend. I can't remember what PSR is, but they'd be allowed to, spend more than $1 billion. So, I mean, they're allowed to lose this at the moment. But let's build out the WACC now. Let's just see if we put this at, say, 7%, what does it do? I mean, it still makes them free cash flow negative until next year. It means they really have to sort out this. Well, no. Well, yeah, actually, if they don't build the stadium, they come out quite, in terms of cash flow, that is quite good. Let's go with that now, because we don't know what is going to happen with the stadium, whether it will actually get built. There's obviously going to be all of the planning. UFCF. All of the planning issues. So let's leave it at that now, and then we can simulate it again in a bit. But we need to build out the WACC. So go in here, menu, take off your grid lines. I'll zoom in a bit. So what is the WACC? The WACC is the weighted average cost of capital, and we calculate it by taking the percentage of equity multiplied by the cost of equity plus the percentage of debt multiplied by the cost of debt multiplied by 1 minus the tax rate. So what do we need for that? We need the market cap, percentage of equity. Make this a bit bigger, this one. Percentage of equity, cost of equity. And the cost of equity is your risk-free rate, your beta, your equity risk premium. Then we want to go debt, percentage of debt, cost of debt, tax rate, total, then WACC. Easy. And your market cap is A1 dot, open the parentheses. Oh, sorry, I haven't put the data in yet. Okay, it's done. Equal, so A1 dot, open parentheses, market cap. Sorry, divide by 1,000,000 as well. Always remember to do that. Actually, no, because, give me 1 second. No, my bad. Divide by 1,000 because we're doing in thousands, not millions. The way the financial statements are by the club. So yeah. So we have that this is our market cap. I think just over 3 billion right now. We need, so the debt is on the balance sheet. Let's have a look. Where's the balance sheet? No, I've got the wrong year as well. What are they saying up here about? Sorry, 1 second. Oh, no, never mind. Where's your balance sheet? Surely not. Okay, here we are. Consolidated balance sheet. So assets. So we know what the cash is. They've got about 86 million in the bank right now. In terms of liabilities, so trade. So well, that's about 472 million in debt. And short term, so this is what they've got to pay by the end of, well, within a year, 165 million. Okay. $471,855. So I mean, it's not an out. Everyone's always saying, "Oh, they've got too much debt," and it's a lot. But in terms of as a percentage of their market cap, providing the market cap stays high, and we know that if somebody's going to take over the club, they've got to go for at least 6.5 billion to even be entertained. That's the debt is a manageable percentage of that total. So the percentage of equity, you take the market cap divided by the total, that's 82%. Debt divided by the total. There we go. Now the cost of debt, let's see, I wonder if I can't remember if they say what. No. The way we'll do that, we'll just go onto the income statement, look at what the interest payment is for the year, and divide it by what we'd be looking at is this one, finance costs. There we go, finance costs. Yeah, let's go with that. So equals 58,988 divided by the debt, 9.2. I mean, it's quite a high interest rate. 26%. I mean, we're always told, you know, anything more than like 8% interest rate, get that paid off as soon as possible. So, yeah. Looks good. Tax rate is it's UK's 25% corporation tax. Let's go with that. Cost of equity, risk-free rate for the UK. What's that? The UK 10-year gilt bond, 4.5. Okay, 4.543%. And because they're generating their revenue in pound sterling, that's what we'll go with. Even though the share price is listed in USD, they're reporting in sterling, so we're going to go with the UK risk-free rate. The equity risk premium. I mean, Manchester United. They are. I mean, they are global. So I think a weighted average of, and they yeah. I mean, you could say, and they're getting bigger in the US as well. I guess, probably the most important market. So I think a global risk premium is fine for them. We'll go with 5.88%. But for the beta, this is going to be, I guess, a bit more tricky, because what would we say? So let me come onto here. Let's filter this out. Industry, what would we say that? Okay, I'd say they're definitely apparel. A bit of broadcasting, we'll put that as, no, yeah, broadcasting, I think it would be, what do you call it? Yeah, I'm losing my train of thought, apologies. Entertainment. Yeah, broadcasting would be, because that's like the match day and not the match day, but the TV revenue for both domestic and European fixtures. Hotel, gaming, household products. Then we'll say it's retail as well. Retail general. Probably this one, retail special lines, because it is quite, it is specific. Okay, yeah. So these are the four that we're going to break Manchester United's revenue segments into: apparel, broadcasting, entertainment, and retail special lines. So let's start that. We can just do it on here. No need to go onto another page. So yeah, industry. Then we don't need to look at sample size. We just need unlevered beta. We then need it to say, we need to know revenue for that particular category, EV to sales. Then we want, what would it be? Proportion? No, sorry. Value, proportion, then weighted beta. Looks good. So what did we say? We're going to go apparel, broadcasting, entertainment, retail. And this is the retail special lines. So the unlevered beta is 0.6. So 0.69, 0.69, 0.7, 0.99, 0.96. Revenue, so revenue from apparel will just go straight on to $144. Yeah, 144. Well, yeah, we can just put this equal to this. Then let's take retail special lines off. I think we need another one for sponsorship though. What else could you call it? Cable TV. Let's call it, I think we call it advertising. Because ultimately that's what, I guess that is what they're doing, isn't it? If a sponsor is paying that, they're paying it for exposure. So yeah, I think we call this advertising. Broadcasting equals, we're just going to put this equal to this one, the domestic plus entertainment. We will say other and match day. Well, no, yeah, let's put match day there, but we'll put broadcasting plus other, because I think this is the YouTube and the in-house okay, it doesn't look like it's working. Equal, so go equal, so broadcasting, we're going to say domestic. You can use the sum function on that if you want, rather than the, yeah, okay, looks good. Let's sum these up. Okay, it's not wholly accurate. Is that right? Yeah, that's right. EV to sales, we want to pull up, let me pull up the other spreadsheet. We want this column here. So let's select our advertising, apparel, broadcasting, entertainment. There we go. 2.75. So advertising is 2.75. 1.41 for apparel, 1.29 for broadcasting, 3.9 for yeah, looks good, which means the value, I got that right. The value is going to be revenue multiplied by your EV to sales ratio, pull that down. Then we take the proportion of each of the segments divided by the total revenue. Pull this down and just, no. 2 decimal places. Column width, come back to 10. There we go. Now you just do your equals unlevered beta multiplied by the proportion. Pull it all the way down, and then you just sum everything up. Yeah, this is not right. 2.36. What have I done wrong right now? Sorry, I know what I've done. There we go. There we go. And we get a beta of 0.96 for Manchester United, which, I mean, to be honest, no matter, people always watch their football team, I guess. We saw that in the last, during the financial crisis, I remember they were still paying, say, 30 odd million for, I think, Berbatov. They were still spending big. So, yeah, your cost of equity, we know what the cost of equity is. It's the equals your risk-free rate plus your beta multiplied by the equity risk premium. So let's do that. There we go. 10.19. Now we can get our WACC. So we do this formula with everything that we've collected here. You go equals your percentage of equity multiplied by your cost of equity. And let's put these in brackets as well to play safe. Plus your percentage of debt multiplied by your cost of debt multiplied by 1 minus your tax rate. Yeah, there we go. Okay, 9.63. Our WACC is 9.63. We'll say that it will grow in perpetuity for 2.5%. The risks are probably, what would you say? So on a bear case, I think I would add instead of normally we add 0.5% for your bear case onto your WACC, but for this I would actually say let's add 1%. Why? And for the bull, we'll minus 0.5%. But we'll just say that there's more risks on the horizon than bullish. For the terminal growth value, just do this plus 0.5%. We do the same here. Minus 0.5%. Make sure to put percent in, otherwise it will take 0.5 away, which would take 50% away, and it would mess it up on the thing, on the formatting. So for this bit, again, it's a bit like the offset to get the switches going. We just go equal, choose. I mean, let me know in your comments what you think the forecast should be for Manchester United, because I mean, I think we all have, this is one where we would all let our biases come through. I'm a Manchester United fan, so I'm obviously saying, oh, it's going to get better, it's going to get better. It can't get any worse than this. But, you know, somebody who's not a fan would be thinking, no, it's going to keep getting worse. And then there's people who probably could be objective, but it's quite hard to be. Okay, So unlevered free cash flow, they're making, it's not great, like 2 and a bit million, but we're forecasting that to go to 50 million, not accounting for the stadium because we don't really know when that will get going. I'm sure it's going to be in the next, we'll have more clarity in the next 12 months, but for now, let's pretend that it's not there. Just put, so 1, because we need these when we're doing to the power. Go equals divided by 1 plus your WACC to the power 1. There we have it. Remember to lock in the WACC as well. Pull it over. Then we want the terminal value. And this is what it is in perpetuity. So the unlevered free cash flow, you go multiplied by 1 plus the WACC divided by the WACC minus the terminal growth value. There we go. So 775 million. Now we want the present value of the terminal value. And this is, you take the terminal value divided by 1 plus the WACC to the power. You don't have to log this one in because we're not pulling it along because it's just for one cell. There we go. So 485 million is the present value of the terminal value. So let's look at the enterprise value now. We need to come back onto this at some point because I need to know what the cash is. So yeah, so your PV of your present value of your terminal value, your enterprise value now is your present value of the terminal value. But we'll do it like this. We go sum PV of TV plus the present value of the unlevered free cash flows that we've forecasted. And we get 580 million. Now we want to, add the cash, subtract the debt to get our equity value. What would it be? The cash on the balance sheet is 86. So it's got an 86.105. And the debt, we're just going to use what we put as in the WACC. Oh God. So it's, you take the enterprise value, add in the cash, and you subtract. So 29 million. The implied, it's like diluted. The diluted shares outstanding are, where is it? I mean, it is losing. So yeah, so they're losing $19 per share. But let's see what the share count is. If you can't find it, you just find it up. Here, there we go. 116 plus 56. Okay, so we go 116.348173 plus 56.080686. Diluted shares outstanding Oh no, it doesn't need to be. We need to put the point there, like that. There we go. Yeah, so the implied share price is, what is that going to be? 29 million divided by 172, 17 cents. Yeah, it's equals J109. Sorry, then go -1. Yeah, so it's not great, but obviously the value of Manchester United is is in the name and the brand. The fact that it can go for the last 12 years with nowhere near as much success as they had in the previous two decades under Sir Alex means that it's a very strong brand, and somebody will. It's yeah, it's really not suitable for a DCF. The I guess football clubs because how do you? It's they almost have a bit of an inelastic demand, which is where I guess the value is the fact that there's probably always going to be somebody that will buy Manchester United. So that's what you're banking on it. That's what you're banking on it to happen, rather than the fundamentals getting better. So yeah, I mean that's what. Yeah, I guess there's not really much. There's not much more to say. But do let me know what you think. Whether you think this is I guess that these are interesting to do to understand what the I guess well, I mean the fundamentals of football teams, because if you think about it, I mean the valuation of Manchester United on the stock exchange being about three and a bit $1 billion, we think of Manchester United as this huge, it's probably the one of the top 10 most iconic names in the world. Yet its market cap is under 6 billion. Well, it's between $3 and $6 billion. You compare that with any blue chip company, they're in the hundreds of billions, 200 billions. Nvidia obviously being Apple being near, 3.5, $4 trillion. Like Manchester United is tiny in comparison, but yeah, it's interesting to get a sense of the scale. But we'll do more of these, and we'll do for clubs that where the goal is not necessarily to end up at Manchester United, but more maybe like feeder clubs, because I think Benfica, Sporting Lisbon, they're listed on stock exchanges. We can do those. We can do other sports entities. We could do something like Ferrari, Mercedes from F1. I think that could be quite exciting to do. But yeah, let me know what you think if you found these useful, and we can keep doing them. But I think yeah, next one we'll go back to doing a normal company. But it's good. It was interesting to look at a different way of doing things and how different sectors use different accounting rules. For example, how they treat player acquisitions. Uh, it's a sort of capex, but not quite a capex. So yeah, okay, cool. Well, yeah, I'll see you on the next one. Let me know what you think, and please do subscribe. Thank you very much. Bye. Sorry, before I go, we've got to factor in that Manchester United reports in GBP, in pound sterling, but they're listed on the US stock exchange in dollars. So I mean, it's really pointless to do, because this is obviously not an accurate thing. But for best practice, we have to we have to convert it to into USD. Do we go GBP USD, or how does it show? So yeah, GBP USD, it's 1.34. So we take, we can put GBP here. And then we just put USD like that. And quite simply, you just take your share price, multiply it by, and there we have it, 23 cents per share is what its intrinsic value is. And we're even being generous there because we're not factoring in the stadium construction costs. So was that J113? Okay, perfect. Yeah, that's done now. Okay, great. I'll see you on the next one. Bye.